When the West technically slipped into recession with high inflation, the excess dollar printing stopped in the US. So the funds coming into the Indian startups dried up. This led to a drastic slashing of their valuations by the same groups which once endorsed their pretty high numbers. Many of the big names were beaten down flat. So, when the same big institutional investors were so hopeful about these companies, what exactly happened that now they have dumped many of their investments? Is it just because the excess liquidity has dried up, or is it much more than that? To understand this, if we look a few years back when the world was just recovering from the first wave of the pandemic, the stock and the private equity markets across the world saw a meteoric rise. Why? Because the plenty of liquid money was printed and made accessible for investors into all of these random startups, pushing their valuation exorbitantly high. From the founder's side, what they overlooked is from where the excess liquidity was coming. US alone printed $5 trillion of cash out of thin air. This was between the two mega events, one the pandemic and the other the Russia-Ukraine war. When the valuation games were running high, financial market experts like Ashwath Damodaran raised concerns that these certain startups had no such intrinsic valuations based on their operations. That means there was no real cash flow from the operations, yet they attracted such ridiculous high valuations, solely based on some estimated projections of some dreamy visions of the future. So, does it mean that the foreign equity houses and the great venture capitalists were ignorant about this fact? The logical answer is no. So there could be two hypotheses. They thought that the Indian market can be manipulated as a replica of the more mechanical US or the Western ecosystem in a different scale. So they tried for complete capture through a twin weaponization strategy of excess pumping of cash and the might of technology for disruption, which is like the classic Amazon's predatory disruption. That is, to capture the whole market by heavily investing in marketing for customer acquisition and then simultaneously applying technology as an instrument of dominance to cut out competition. This could be far more deep-reaching than just the business interest. What if the global powers, infamously known as the deep state, wanted to take maximum control over the growth of the Indian economy as a whole, but in new methods like something often debated as neo-colonization, that is, colonization by replacing the use of gunpowder and military with the advantage of a captured market, technology and endless flow of the powerful fiat dollar. Because markets, however claim to be free-flowing, are actually never free, but tilted towards the side where there is power, technology and money. Coming precisely to our second hypothesis, the involvement of possibly the deep state lobbies, which is the nexus of the gigantic fund houses, the military and industrial complex backed by the enormous printing capacity of the US dollar. If we take into account their strategic involvements clubbing with the theory of neo-colonization, there are three gray areas which have raised serious concerns about their real motives. 1. To take full control of the most promising new businesses. Example, Flipkart and PhonePe, two of the excellent creations of the Indian startup ecosystem. The ownership has been taken over by American retail giant Walmart. India, being the fastest growing economy, has much of the greedy eyes of many of the global giants. In short term, this may appear good from the Indian investment scenario, but at the end, to keep the Indian growth story intact, the entrepreneurship has to stay in Indian hands. Losing the ownerships would only create another new set of salaried working class and a huge user base, which would eventually dampen the possibility of India's legitimate rise as a global economic power. 2. Excess cash inflow to disrupt the existing market fabric of the MSME sector, which is the medium, small and micro enterprise. India already has a vast MSME spread which provides 30% of the GDP and jobs to 40% of the existing workforce. So even though scattered and semi-organized, SMEs are extremely vital for the Indian growth story. Any world power, be it the West or the Chinese, would never want the smaller SMEs to grow to scales which could challenge, pause and reverse their established hegemonies. The West has already experienced it from China. So given any chance, they will try to disrupt the sector and cripple it at the very beginning. 3. The attempt of a final nail in the coffin would be to influence out the whole situation into their strategic favor, simply by pushing the valuations at such scales that would form a closed syndicate, keeping the legal compliances in their favor. This could even eliminate the chances of acquisition by the big domestic players. And finally, the pumped in money could be drained out from common retail investors by listing in the Indian stock market. The education tech sector offers a compelling case study. It is particularly sensitive from a geopolitical perspective as the nation's future hinges on how effectively it nurtures its young population, and that in a time when India is having the largest young working age population on earth. The root of the problem lies in its operations and methods adapted by certain Edtech startups. By this time, you must have been aware how the once indomitable $22 billion valued giant BYJU'S from the peak of supremacy collapsed like a pack of cards. Therefore, the grand strategy of capturing large markets by pumping excess liquid money failed to a great extent, which the funding lobbies perhaps did not anticipate. If you remember, this was mentioned in our first hypothesis. So, where did this strategy go wrong and where are the inherent fault lines? Number 1. Almost the whole growth came from forced marketing through excess cash burning till one day all incoming funds got dried up, way before there was any profit while there was no such organic growth. The customer base is highly agile. People need to connect the product to their emotions or else artificial marketing gimmicks will one day fail. Number 2. The businesses lacked differentiation and unique value generating products. Mostly the startups were either a copy of one another or had weak products to offer, or its actual utility factor was too low to survive on its own. To add fuel to the crisis, there were no direct human contact. The customers interact through an opaque and lifeless digital platform, creating a strong psychological barrier, and that too when promises offered are often misleading. The Amazon story might look enigmatic on paper, but replication won't survive without having anything to offer which can remotely match Amazon's innovation quotient. Number 3. With mechanization of education like a factory produce using expensive technology, profitability just vanished because all of these businesses are too dependent on high-cost tech, which they mostly import from the same groups who fund these startups. This mechanization underestimated the morality and cultural ethics which is involved in the teacher-taught relation. The startups were just forced to grow marketing, acquisition and manipulative practices without looking at the real value addition to the people's lives, till the uncertain events overpower everything. That uncertainty arrived with the Black Swan Event, the Russia-Ukraine war. This triggered the collapse of the global supply chains. The West faced a double shock: soaring inflation and massive war expenses due to supply chain disruptions. Even though India is significantly shielded from the very high inflation, economic downturns like Europe and slowdown in the US, yet many high-valued startups have seen their valuations slashed drastically, while some are even facing extinction. Once booming sectors like Edtech, which boldly predicted the demise of traditional methods of teaching and education, are now struggling even to survive. Meanwhile, most conventional sectors have rebounded effortlessly. This does not mean we should only cling to traditional models, but it highlights that without a real use case benefit for users, technology alone cannot sustain itself in the long run. What does it mean that it cannot sustain in the long run? Considering the symbiotic relation of technology with real market demand, where did the Indian startup ecosystem fundamentally go wrong? Point 1. Denying the fundamentals of business, which can never change. Just by sprinting on market capture by burning cash, it spirals into a permanent loss. 2. Lack of originality and innovation in the business thinking. Every company is burning huge cash to catch up the same set of customers using the same set of products without any such differentiation. Point 3. Too much focus on valuation game. As money was pouring in like freebies, running for the egoistic valuations became the primary goal more than profitability or organic growth. Point 4. Support level products and not knowledge level products. Most of the startups were a digital makeover of standard brick and mortar businesses without having anything special to offer. And 5. Copying the US mindlessly. It always looks easy to replicate any model of business which may have seen success somewhere else, for example the US, but often it is overlooked that the Indian socio-economic dynamics are largely different, which may often lead to massive business failures in the long run. Let's assume that someday the necessary funding for Indian startups regain speed, and then how can the course be corrected into a more sustainable and empowered position? Point 1. Strengthening the core business for profitability and sustainability. It needs to shift into a knowledge economy from a support economy. Innovate to cause disruption and not just replication. Because value thrives through disruption of grand scales. Interestingly, Ola, which entered the market as a cab aggregator, first diversified itself into a large-scale manufacturing and then presently shifted to building core technology and AI platforms, decoupling itself from the hinges of the US big tech. And they named it as Kritim, which is Sanskrit for artificial. Point 2. VC funds to be used for a launchpad and not perpetual dependency. Because if the business model is ordinary and loss-making even in the long run, then in due time competition would eat up the existing market share, and if it happens, the same VCs would dump it out of their books. Because venture capitalists are driven by a relentless pursuit of profit, prioritizing only on the financial gains above everything else. Point 3. It is necessary to keep the principal ownership in Indian hands. Otherwise, as said earlier, allowing great businesses to fall under the foreign control would only be a modern form of colonization. Point 4. Operate in local character but build in qualities for the world, and not the other way around. For example, in China, there are innumerable companies which are extremely localized, but they manufacture world-class products which are in demand by the whole world.